It is hard to understand who provides money for loans and where the money goes in decentralized finance. It can also be hard to know how easy it is to trigger a currency meltdown. People who invest in cryptocurrency are still figuring out what caused the spectacular meltdown of two digital tokens in May. The tokens were worth more than $40 billion earlier in the month. An analytics firm, Nansen, said that a few lenders, including Celsius, caused the collapse of the Luna and TerraUSD cryptocurrencies. However, Celsius disputes this account. The search for information about the cause of the wreckage highlights the opacity of the world of decentralized finance. DeFi is challenging to understand because it is hard to know who provides money for loans, where the money goes, or how easy it is to cause a currency meltdown. This is one reason why regulators are concerned about the impact of DeFi on investors and the broader financial system. Many investors have put their assets into crypto products that offer healthy returns. The services then lend out the funds to others. The total value of assets held on DeFi platforms, termed total value locked, skyrocketed from $600 million at the beginning of 2020 to a peak of $317 billion on Deck 26, 2021, according to the website DeFi Llama. It is now down to about $106 billion, falling in tandem with the decline in the overall cryptocurrency market prices. The Anchor protocol was popular because it offered users a high interest rate on crypto loans. However, in the month of May, many investors started withdrawing their money from Anchor, which led to the fall of TerraUSD and Luna. It is unclear who caused the selling and whether they meant to trigger the collapse. Nansen's report argues that Celsius was one of a few users who first withdrew a lot of money from Anchor early, possibly triggering the broader sell-off on the platform. Celsius said that it removed its assets because of shifts in the stability of the platform. The company wanted to protect its customers' money. It didn't profit from the instability. Celsius allows people to deposit money with them and then lend it to other users, like exchanges and market makers. They charge a fee for this service and then pass on that revenue to their users as an interest payment. Celsius offers users up to about 14%, so Anchor's 19.5% yield was attractive to the firm. Corey Clipson, the CEO of Swan Bitcoin, says that the new product being marketed as a better savings account is not a good savings account. There are no laws that state how custody, risk management, or capital reserves should be handled. There are also no laws stating how transparent an investment needs to be. This means that often, investors do not know who their money is being handed off to or how it is being managed. What you're really doing is lending money to people who are not very likely to pay it back. They are borrowing money from regular people like you and me and then using that money to invest in things that aren't very well regulated. For example, some investors didn't understand that their money in a Celsius account might have been invested in the Anchor platform. Celsius, Voyager, and others in the industry usually don't disclose their counterparties. Regulators have been increasingly worried about the risks of these lending platforms. In the month of April, Celsius stopped accepting new interest-earning deposits from non-accredited investors in the U.S. after pressure from regulators. A similar program planned by Coinbase was dropped after opposition from U.S. regulators. DeFi services are not as safe as traditional bank accounts. If one collapses or gets hacked, the users are on their own and won't get their money back. Stay tuned with us and check back for more information by subscribing to this channel, and don't forget to turn on the bell notifications.